You want a big loan for your business, but you don't have land, you don't have property, and the bank is looking at you like you just asked to rent a flat with no credit history. Sound familiar? Well, the government just changed the rules. And this one actually matters. As of February 24th, 2026, the Finance Ministry has upgraded the MSME, that's the Mutual Credit Guarantee Scheme for small and medium businesses, and the changes are genuinely significant. Here's how it works at its core. The government, through an agency called NCGTC, acts like a cosigner on your loan. It tells your bank, if this business can't repay, we'll cover 60% of your loss. That one promise is what makes banks say yes when they'd otherwise slam the door. Now, what actually changed? The guarantee now covers loans up to 100 crore rupees, specifically for buying plant and machinery, the heavy equipment that powers your production line. That's a ceiling most growing businesses couldn't even dream of touching before. And if you're in the service sector, running an IT firm, a consultancy, a design studio, you were completely locked out of this scheme until now. That door is officially open. Then there's the fee structure. You pay 5% upfront to access the guarantee. So on a 1 crore rupees loan, that's 5 lakh rupees. But from year 4 onwards, if your loan is performing well, you get 1% back every year. Think of it like a security deposit. Behave well, get your money back. And here's the trend our infographic is tracking. Access to collateral-free credit for MSMEs has been on a steady climb. And this upgrade pushes that curve sharply upward, especially for service businesses that were previously invisible to this system. So that's the what and the why. But you're probably wondering, who exactly qualifies? And what does actually getting this guarantee look like in practice? That's exactly where we're headed next. So the scheme sounds good on paper, but not every MSME is going to benefit equally here. And being honest about that is way more useful than just celebrating the headline. Let's break down who's actually winning. The clearest winners are service sector MSMEs. IT companies, consulting firms, logistics coordinators, digital agencies. This scheme used to be basically a manufacturers only club. That wall is gone now. Need to finance servers, specialist software, professional equipment. You've got a 60% government-backed guarantee behind your loan application. For a sector that was completely invisible to this scheme before, that's a genuine game changer. The other big winners are established exporters. Specifically, if you've been exporting for at least 3 years and export turnover makes up at least 25% of your total revenue, you get 75% guarantee coverage, a first-year fee waiver, and an upfront contribution of just 2%, capped at 40 lakh rupees. On a 5 crore rupees loan, that's 2,50,000 rupees less upfront compared to a general MSME. Not nothing. And quietly, banks and NBFCs win too. With 60 to 75% of the loan risk sitting with the government, lenders become a lot more willing to say yes to businesses they'd normally pass on. More approvals, faster processing. Now, who's still struggling? If your business is cash tight right now, that 5% upfront contribution is a real catch-22. On a 1 crore rupees loan, you're paying 5 lakh rupees before you've seen a single rupee of benefit. That stings. New exporters and startups miss the premium exporter terms entirely. You need that 3-year export history to qualify. And if you're a retail trader or an agribusiness, pull up the on-screen comparison. You're still completely shut out of both C, G, T, M, S, E in this scheme. This update doesn't change that reality for you at all. So now you know who this helps and who it doesn't. Next, let's zoom out and ask the bigger question. Does this actually move the needle for India's MSME credit problem, or is it just tinkering at the edges? So now you know what changed and who it helps. The only question left is, what do you actually do with that? If you run a service business, a consultancy, an IT firm, anything non-manufacturing, your first move is simple. Check if you're registered under the MSME definition. Turnover and investment thresholds apply, so confirm that first. If you qualify, you can now walk into a bank or NBFC and ask for an equipment loan backed by this guarantee, without pledging your property. That's not a small thing. That's your borrowing power just got an upgrade. Now, if you're a manufacturer or exporter who's been sitting on a capital expenditure plan, new machinery, a production line upgrade, expanded capacity, this is genuinely the moment to dust that off. And here's where the infographic on your screen earns its keep. On a 2 crore rupees loan, the 5% upfront contribution is 10 lakh rupees. Yes, that stings. But from year 4, if the loan performs well, you start getting 1% back annually. That's 2 lakh rupees a year, every year. Over a 7-year tenure, you're recovering 4 to 6 lakh rupees of that upfront cost. Run that through your ROI before you write the scheme off as too expensive. For exporters specifically, if you're close to hitting that 3-year export history or the 25% export turnover threshold, plan your next financing round around that milestone. The jump to 75% guarantee coverage, the first-year fee waiver, the lower upfront contribution. It adds up to serious savings on a large loan. The broader signal here? The government is actively trying to widen the credit pipeline, especially for services, one of India's fastest growing sectors. Including service MSMEs isn't just a technical tweak. It's an acknowledgement that modern businesses don't always look like factories. This scheme won't fix every financing problem. The upfront cost is real, and some sectors are still locked out. But for eligible businesses ready to invest in growth, the government just made it a lot easier to get a bank to say yes. The question now is whether you're ready to ask. Follow us for more updates like this. Thanks for watching, and don't forget to follow us on YouTube, Instagram, and X.